Hello, my name is Lee Presser. This is my show. I speak frequently to very interesting people. Some of these conversations are so exciting, so intellectually stimulating, I thought others might like to listen in. This is the reason we started recording Conversation with Lee Presser.
Welcome to Conversation with Lee Presser. After the crash of 2008, tens of millions of Americans missed mortgage, car loan, and credit card payments. Creditors reported those missed payments to the credit bureaus. The next time the borrowers asked for additional credit, the companies offering credit said, yes, but you must pay a much higher interest rate than you did on previous loans. When the borrower again failed to make timely payments, credit became unavailable. Right about that time is when the borrower's car got totaled. The borrower said, I have to have a car to get to work. And he or she went to the dealership to buy a replacement car. Well, the borrower had no cash, no credit. Now, what's to be done? Today we're going to talk about repairing your credit. Our guest today is Jimmy Kavadas, known in St. Louis as your credit man. Mr. Kavadas has for decades worked with good people who have gotten into financial trouble. He helps people make the long trip back to where they can again buy on credit without paying unusually high interest rates. Jimmy Kavadas, welcome to Conversation.
Thank you very much for having me.
So let's just review, like you and I did in our private conversation, about how you got started in this credit repair business all the way back to when you were a junior car salesman.
Well, that's basically it. I've been in the industry for 40 years, and I learned it all from bottom up. And 10 years ago, or rather before that, I got into what they call the secondary finance. And secondary finance is people with credit blotches, trouble with their credit.
When you say blotches, I mean, these are people, some of them who have just failed completely, right?
They failed completely. Some were caught up in '08, but this happened way before '08.
Right.
This was going on, I would say, back in '89, '99, right in that area. But I learned it, and I learned how to get people loans, obtain loan financing for them. But I wanted to make a difference. So the problem with getting a high interest loan is people are stuck in them. And they're stuck in them for 5 years, 6 years. So I devised a method to get them out of that high interest rate. And it's not rocket science, it's very simple. They establish a relationship. They start off with a high interest loan. Then once they pay that loan for a year, they can refinance that loan to add a lower rate and build a relationship with another financial institution. So the objective is to get them on the track of paying their bills and staying within their means. Now, you could take a horse to water, you can't make them drink.
Well, now that's the important part right there. People need to understand and explain to folks that the credit bureaus are constantly monitoring. If you miss a payment more than 30 days, it gets noted. 60 days, it gets noted. And then the people who you go to ask for credit, they actually read these reports. And so what you're trying to do is undo that damage by proving that, yeah, I screwed up there, but I can make payments on time, right?
That's correct. You can't change the past, but you can change the future.
And that's what you're trying to work on, is to get them into the habit of paying on time.
That's correct. We are creatures of habit. I hate to use this as an example. I'm a smoker. 90% of it's habit and 10% is addiction. So once we get into that habit of saving and paying our bills on time, then we will succeed. Example, let's say a gentleman files bankruptcy. Unfortunately, people are filing bankruptcy today. Now, the bankruptcy law was put into effect by our forefathers to give us a fresh start, not a way of life, but a fresh start. Is bankruptcy bad? General Motors filed bankruptcy. Chrysler filed bankruptcy. The difference was they had the government behind them to give them a fresh start with money. So as an individual, let's take an individual, just a little person like me. I'm a little guy. You file bankruptcy, but you got to have a plan. You just can't go out and file bankruptcy and then turn right around and think your credit's going to be good. You got to reprove yourself. So the plan is unfortunately, let's say a person has to file bankruptcy. They go file their bankruptcy. There are lenders out there that will give them a loan the next day after bankruptcy. Now that sounds crazy, but they will, because they're wiping out all their financial obligations and they're starting fresh.
And they can't do that again for
Another 8 years.
8 years.
However, there are Chapter 13, that's another story. They can go into a Chapter 13 right after a bankruptcy, but they can't get discharged. But getting down to the Chapter 7 is where you wipe out all your debt, and you're allowed to keep like $1,500 in savings. You're allowed to keep certain assets.
Can you keep the car that you bought from just the Ford dealership? Okay, you've got your SUV. It's a $30,000 vehicle, and you've now failed to make payments on that. What happens to that vehicle?
If you're behind on that vehicle, it's hard. You probably could reaffirm the debt. Now, reaffirmation is basically, simplify it, is where you file your bankruptcy, and once your bankruptcy's discharged or during your bankruptcy, you have a right to reaffirm the debt. That means re-sign a new contract that after your bankruptcy, it's a new contract, you're starting fresh. To make that decision, you have to determine, is that car worth what you owe on it? If the car is worth $5,000, you owe $15,000, it's not really wise to reaffirm $10,000 out of equity. The objective is to wipe out all your negative debt.
So what, you turn in the car
You
then?
turn in the car, you purchase a new car.
Well, wait,
Yeah.
right. But you turn in the car, now you go back to the dealership, I want to buy, and they're like, what, are you kidding?
Well, that's where I come in.
Right.
Okay?
Yes. But at the regular dealerships, it's like, what, are you kidding?
Correct, because it's a program designed to get people going forward. And most dealers, some dealers have it, but most dealers really don't understand it. And I don't want to say that 100%, but the difference in filing, you got to
They don't need the trouble. There's too many people who know how to pay their bills. They don't need the trouble with dealing with people who don't know how to pay their bills.
That's correct. And to be straightforward about it, I have a passion. And the passion that I have is that I've been bankrupt. I've been broke. I've lost almost everything. The only thing I saved was my home. So I understand the feeling of bankruptcy, and I respect bankruptcy. I respect what our forefathers gave us, that opportunity. However, I try to teach people that if you file a bankruptcy, once you buy the car, you start off fresh. We could start you off with another lender. Let me give you an example, a very good example. You file bankruptcy today, Lee.
Okay.
You have a car that you're $10,000 upside down. I take your credit, or you have to have the criteria, you have to have the income to support the debt.
I was going to say, first you have to have the job.
Job.
So if the problem, before we even go there, if the problem was that I used to be an executive for a company, a big company that now, it's been bought up or it's out of business. And so I don't have that big salary anymore. So I used to make $90,000, $120,000 a year. And now I don't. Maybe I've got a job that's paying me $50,000 or $40,000, and that's as good as I can get. Now, what do you do with someone like that?
That's when we have to take a step backwards and readjust our thinkings. And that's where the bankruptcy comes in, where you've wiped out all your debt. Now you got to readjust everything to your income level. A very easy way to do it is, let's use an easy example of $2,000 a month. That's just for small numbers. 50% of that money is what you have available for debt. That means $1,000. If your rent is $500, now you have $500 left. Now, if your car payment's $250, which is very rare, $250 a month, now you got $250 left. Your insurance is $100, now you got $150 left. That's all you have for obligations.
To eat off of.
Well, no, the 50%, when you go 50%, that takes into consideration eating, electric, gas, and your taxes. So that's why they go 50%. That's called 50% debt to income
okay.
ratio. So that's a good guideline. If you go by that, you'll never overspend. Because if you know you only got $100 left, and somebody says, well, here, I want to give you a credit card with a $1,000 line of credit, you can't pay that $1,000 off in 30 days. You're going to wind up paying a $100 minimum and over $1,000 the rest of your life. That's the bottom line.
Right.
So
credit cards are not a good deal. They were supposed to be a way of going and buying something that you're temporarily short. You buy it, and then when you get your money in the bank, then you paid it off.
That's correct.
That's how it was supposed to be.
But what happens is our emotion and our impulsive buying. That's what happens with credit cards. And credit cards, to be quite honest, are giving to children. Let's go back to how credit is really destroyed, is with our kids going to college, for example. They go to college, they go to sign up, and the next thing you know, there's a table out there that says, I'm going to give you a free blanket or a free bag to carry your books in if you sign this up for this credit card. They haven't even got a job, and they're giving them a credit card with a $1,000 line of credit. Now, what is the kid going to do? He's going to go out, he's going to buy a stereo, and if he's might go into a bar and have a drink with the credit. But when the bill comes, he hasn't got the money, and he doesn't realize how that affects his credit when he goes back. Now he's in the 25% bracket to buy something.
Yeah, slow down now so that people understand that. So he's run up $1,000. The credit card bill comes on the 15th.
He doesn't pay.
Doesn't pay it. So sometime 45 days, 60 days later, now he's seriously past due on making that payment. So the credit card company says, hey, Experian or TransUnion or whatever the names of these credit bureaus are nowadays, this guy borrowed from us and he didn't pay it back. He's 30 days past, 60 days past, 90 days past.
Correct.
Now somebody at the dealership, a car dealership or selling furniture, they pull up the bureau, right?
Correct. We pull the bureau, we look at it, and we see what's on the bureau. And a lot of it's credit card debt written off. It says profit and loss write-off. But they can't, then the bottom line is it's not only credit card debt, it's everything. Let me kind of go back to what I try to tell people. Folks, if you borrow $100, or let's say you go in the hospital and you got a bill, and they send you the bill and people don't have the money. So instead of approaching them, they let it go into collections, where once it's on the bureau, it's done. So that $100 that went on their bureau on the collections part is costing them $5,000 in a new purchase by not paying $100. Because it's on the bureau.
Right.
But you can stop it at the forefront.
And you're saying because it's on the bureau, they wind up paying higher interest rates,
Correct.
Which is what's costing them
That's correct.
more money in the long run
Correct.
than if they had just paid the bill on time.
That's correct. So if you borrow, even Blockbuster, or let's take any company that they send you a bill and you say, throw it in the drawer and throw it away, it goes on your bureau. So that rates you and that lowers your credit score. Credit scores are, in my opinion, a joke because the bureaus are incorrect. A lot of these bureaus are really incorrect. And to try to correct them, you can't do it today, even though by law.
There's nobody to talk to.
There's nobody to talk to.
No phone number where there's a real human being.
And that's the big issue. But getting back to how to reestablish yourself, and really the difference is, what I do, it's killing two birds with one stone. Providing transportation, good, reliable transportation, a low-mile car with factory warranty on it, so it doesn't have any problems after they buy it.
Right.
Now,
because they don't need the problems of having to go and fix the transmission or a new engine, or you throw the car away.
And everything's mechanical and anything can happen. But if you buy a late model car, you're pretty much safe, because the manufacturers make beautiful products
Yeah, they
today.
do.
They really do, and they
Around
last longer.
150,000, 200,000 miles.
Yeah, it's not like in the old days at 80,000 you throw them away or you traded in them in. But what I do is I explain to a person or share thoughts with them about purchase this car. Then after you purchase this car, I want you to join this financial institution, and I want you to set up a savings account, and I want you to save $100 a month. And I also want you to put your car payment in that savings account, and I want you to have that car payment automatically deducted to the lender I set you up with. Once you do that for 1 year. Now, of that $100, the lender, the financial institution that does this, reports to the credit bureau $50 a month as a loan. It's not a loan, but they report it as a loan. So at the end of 1 year, you have a $600 loan paid as agreed. You also have a car loan paid as agreed after your bankruptcy. Mm-hmm. So now everything's negative here, it's all positive here. Now you also have $1,200 in savings, which is getting you into the habit of saving. Savings are at their all-time low. Nobody saves any money today. Our fathers
Not
told
paying an interest on the savings, you know.
Our fathers told us, pay yourself first.
Yes.
Okay? I didn't take that advice. But I understand it now. The older we get, it's not that we're smarter, it's the experience,
right?
The pain.
Getting kicked around.
Getting kicked around. My father said, don't put your hand on that burner. Until you put your hand on that burner, you don't know what I'm talking about. And that's just a little thing like that. So I try to guide people in that direction. 70% of our public has got credit problems. 70%. And part of the reason for that, or majority of it, the jobs, the incomes for the cost of living. That's the truth. Mm-hmm. Incomes are here, prices are here, which create debt. When I was a young man, prices were here, income was here, and you could save money. It's hard to save today because of that.
Right. So your advice is very sound. You've just said that under this plan that you've now shown the Bureau, which means anybody who's looking to extend you credit, that since your bankruptcy, you now have 2 loans that are showing paid on time.
That's correct.
Now, do utility payments count in this at all?
No.
So
No.
you pay the electric bill? No.
No.
And of course, you don't have a mortgage payment because you already lost the house.
Correct.
Rent payments, they do or they don't count into this?
They don't count into this.
Right.
Also, the most important thing of this is you're building a relationship with a full-service lender, because most car loans are just the finance company that finances cars only, whereas this lender gives home loans, gives student loans, gives all types of loans. They're a full-service lender. And you're building a relationship, just like a marriage. It takes time to build that relationship, gain trust, and earn credibility. And people don't really understand the meaning of the word credibility. It means I'm creditable,
right? And
I will pay my bill. Now, if you get sick or something unforeseen, what are you gonna do? What are you gonna do? If I was sick, let's say I owe you a bill, and I'm in the hospital. I can't make my payment. Somebody, hopefully in my family, would call and say, he's in the hospital. I get out of the hospital, I pay. Should I be bad rapped or looked down upon because I was in the hospital? No. The objective is to pay you what you loan me, and that's all it's about. And it's simplified that way. But there are laws that stop people from working with each other, that say, well, if I take this, now I've readjusted this. If I do this, now I can't do this. What I'm talking about, the laws, that they can't go against the person if they do something for them. Like in the old days, when we did loans, you took a credit app, you went to Southwest Bank, you made a loan, you paid the guy. I call Southwest Bank and say, how did John pay you? John paid me. You know, he stubbed his toes a couple times, but he never beat me out of a penny. That's how credit was given. It had nothing to do with credit bureaus, computers, or anything.
Personal relationships.
Personal relationships. And that is gone today. But we try to establish.
And that's an important part right there, that first of all, the local bank is basically gone. There's only the big name banks, and the decisions seem to be almost computerized, as opposed to what you just said, that you know Joe down at the bank, Joe knows you, and so it's like, okay, I trust. I know you had some problems, you were in the hospital, whatever, but I trust because you paid in the past that you're going to pay.
That's correct. And the best lenders today, and I don't want to get alienated anyone.
Right. We're not going to name names.
I'm not going to name names, but I have to say credit unions. I have to say credit unions. Because credit unions are truly for the little guy. And I'm not down in the banks, I'm just saying they're regulated different. Banks are regulated by the government different than the credit unions. So credit unions have a little bit more flexibility. And they exist to improve the financial responsibility of their members through products, services, and education. And education, they're supposed to teach their members how to save, how to do this. That's what they exist for. So I'm a firm believer in credit unions. And now, do I have a bank? Yes, I have a bank, but I also have a credit union. So that is one of the main sources of coming back is credit unions. They will help you where others can't because of their regulation is less on them.
Now, in your business, and it is a business, you're not a good Samaritan out there trying to, be a priest and help the world.
That's correct.
You do make money off of this process, right?
Yes, I do.
And how are you making your money?
I make my money, most of my money is made on my buys. In other words,
selling cars.
Selling cars. The profit's in your buy.
Not in your advice and not
correct.
Not in the credit situation. You're
correct.
not making money off of the credit part.
No, that's just trying to be different than anybody else.
Right.
I'm trying to have a compassion for the person. I'm trying to guide. I'm not a lawyer. I'm not God. I'm just an individual that really does care about people.
How often do the people who come to you that you're trying to give them this good advice take it, versus the ones that they're like, hey, I'll find some way, or yeah, I'll listen to you, and then they wind up not making the payments and wind up in trouble again?
As far as that, I don't know who winds up in trouble again. As far as refinancing and going through the process, 50%. So out of 10 people, 50% really sign up with the program. The other 50% just keep doing business as normal as before. Like example, you cannot trade that car. If you buy a car for 5 years and you're at a high rate of interest, you're in that car loan for 4 years, if not 4.5 years. My process is, if you buy the car, refinance and join this lender and refinance after 1 year and cut the term from 5, you have 4 left, right? You cut it 1 year, refinance for 3 years, your payment stays the same because they've lowered the rate. Now you could trade at another year.
And get a better car.
Get a better car or keep the car. You're getting out of debt faster. You're paying down principal, you're not paying interest. It's not rocket science, it's very simple. But what people look at is they look at the monthly payment. They don't look at how long am I financing for.
Right. Can I get rid of this turkey?
Can I get rid of this?
If it's not working right?
That's correct. They don't really realize that. And it's because it's instant gratification. Or some people say, I got to have a car today. I mean, today. They can't wait a week. They can't wait for this or wait for that. And they go wind up making a bad buying decision. It's that simple. They overpay. The difference, and I'm going to put it very simply, the difference between a loan at 20% interest and the difference between a loan at 8% interest. A $15,000 loan at 20% interest at 5 years, the payment's right around $430 a month. At 8% interest, the payment is $302 a month.
That's an enormous difference.
It's $150 or right around there. Now that $150, if they had good credit, instead of buying a $15,000 car, they could be buying a $21,000 car.
Right.
That's $6,000 buying power that they're losing out on, and they're throwing it away just because of their situation.
We got about 3 minutes left here. Is there anything that you wanted to say that we haven't covered? I always give people that, tell them that we're at that point.
I just want people to understand that there is a way out. There is no doom and gloom, but you just got to go to somebody that's going to tell you the truth. And I'm too old to play games. I'm 65. I told it now. I don't tell that to too many people. But life's too short. I tell the truth. I try to help people to go to the right direction. This is not a commercial. This is what I honestly do from my heart to them. So if I can help somebody, I welcome them. If I can't, I'll tell them the truth. That's all.
And you've been doing this, I mean, this has been your business. You're not some Johnny come lately. You've been doing this a long time. You have relationships with financial institutions that may be able to help people who have destroyed their credit.
And they're good financial institutions.
Right.
They do want to help people.
But not everybody. Not everybody's going to wind up driving out with a decent vehicle.
You have to have qualifications. I mean, you have to have a job.
Right. There's the first thing.
You got to have a job. You got to make X amount of dollars, and you got to be able to afford the payment. Your past is your past. I try to go to the future, but you got to have the qualifications to be able to get a loan.
When you say you got to have a job, if I got that job 2 days ago or last week, is that good enough? For some lenders?
For some lenders it is. If you got a job that you've been on, just got hired in, you got a job letter saying that you're going to make X amount of dollars, we can use that. What lenders are looking for is stability. In other words, stability, ability, and willingness to pay. And the stability comes from the jobs, but the stability's been kind of like destroyed because of '08. There are no jobs like we had in the old days where you're going to be there for 50 years.
In about 10, 15 seconds, what paperwork do people need to bring to you?
They need W-2, their W-2s from last year, last paycheck stub, and basically that's it. I can get the rest. But the main thing is their W-2 and their income. That's all I need. And they could go to my website and fill out an app, which is yourcreditman.net.
Right, and it's been up on the screen throughout.
Okay, and once they fill out the app, we call them back immediately and verify everything. Then we make an appointment, and then we sit down and talk to them.
Thank you very much for coming and speaking.
It's been a pleasure. Thank you.
I really enjoyed this. Thank you very much. And I've been speaking with Jimmy Kavadas, known in St. Louis as Your Credit Man. He has a plan for those who have had some credit problems. If we're going to upload this to YouTube, just go look up Conversation with Lee Presser, Jimmy Kavadas. You can show this to anybody. Thank you very much. We'll see you next time.